Hello, a very warm welcome to HYCM's online trading workshop with myself, Giles Copkin, Chief Currency Analyst here at HYCM. Hope everybody's doing well. Good to see you. Warren, Shwa, great to see you. Salman, Neeman Naked, a special welcome to you. Ashwin, and good to have you as well. Now, looking forward to taking us through this next session and analysing some of the latest Brexit moves in particular. So before we get going, just remind ourselves that the whole point of this webinar and workshop is that you look over my shoulder and you see how someone with a professional trading background goes about making decisions, combining fundamental and technical analysis. So the whole idea of this webinar is not a signal service that, I tell you what to trade and then you go and trade it. Instead, you see my thinking process. I share some of the trades I'm in, and you understand the educational process behind that, as well as just generally analysing the markets, just to make that clear as we get going. During this session, remember the first thing and the major principle we want to do is to pair strength against weakness. That's always what we're wanting to do in the financial markets. We want to have, whenever we're trading different currency pairs, a strong currency against a weak currency. I'll be demonstrating that principle for us today, and we're going to look at a dominant currency sentiment pair, and I will show you how you go about analysing that, and then how you go about analysing the technicals, then also how you go about deciding entries, exits, etc., etc. The main session will revolve around that. We'll also be giving some market context. I'll be just explaining what the recent market moves, the broader concepts, particularly moving into the US election. And I will be answering this one question, this bonus section: who are the United States trading partners and how does that impact FX? And I'm going to be starting by answering that question. So the major partners of the US are here. You can see here, 2019, that the major US trade partners were as follows. There were Mexico, China, and Canada. These three countries really form the bulk of the US's trading partners. Now, the significance of that is quite obvious, particularly when you look at the US-China trading partner, particularly with the US and the protectionist policies of Donald Trump. What we've seen is that Donald Trump has had a number of tariffs which he's put on China. China have retaliated with tariffs during President Trump's presidency, and the US and China, between the two of them, are the two world's largest countries that contribute to the world's GDP. The US contributes around 25% of the world's GDP. China contributes around 15%. So it's between the two of them, about 40% of the world's GDP come from US and China. So the state of the US economy and the Chinese economy is very important, and trade tensions between US and China are also very important. So if we just go over to the charts, I want to show you something, and you'll see the significance of this trade screen in a moment. Just going over to the charts. Let me just move that over to the other screen. Now you can see on this chart, we'll just take a look at the dollar index. So this is the dollar index, and just running over what's happening with the dollar. At the moment, we are seeing the dollar is just having a little bit of weakness. Now, the reason we've got for the dollar weakness is, and there's multiple reasons for dollar weakness. And if you just zoom out onto the monthly chart, look, you can see that the dollar is just breaking out of this very key ascending trend line, and this move lower is very significant for the dollar on a monthly basis. Now, the reasons for the dollar weakness are quite pronounced, and the reasons for dollar weakness are as follows. There is very low US rates, which is pressurizing the US dollar. We have huge amounts of quantitative easing from the US, which again is pressurizing the US dollar. And we also have, and this is where that trade diagram comes into play, a widening election gap between President Trump and Joe Biden. If you just have a look here, what you can see is that President Trump, who's a Republican candidate in the US, is falling behind the popularity of Joe Biden, who is the Democrat candidate for the US election. So Republican Trump versus Democrat Biden. Now, Biden is ahead in the polls. So if there is this shift towards the blue, if Democrats end up getting in power, what are they going to do? Well, the Democrat is obviously going to unwind the protectionist policy that President Trump put into play during his term of office. So going back to the main screen, you can see here that trade relationship between US and China can have a big impact in the FX markets, because if trade between US and China all of a sudden, instead of Trump's tariffs and protectionist policies, if all of a sudden Joe Biden starts working back on that, says we're opening up our arms to China, we are not going to be putting tariffs, we're going to make trade easier and facilitate trade rather than hinder trade, that is going to be a big boost to global emerging markets. It's going to say a big sign out to global emerging markets that the US is going to be helping industries and businesses across the world. In that scenario, we would expect the US dollar to keep weakening. So a Biden presidency is good news for the world, but bad news for the US dollar. That's the expectations at the moment. Now, on the other hand, if we start to see that Trump-Biden gap narrow, if President Trump starts to get ground on Joe Biden and there's a perspective that perhaps President Trump is going to win the next election, that will be dollar positive. And so we'd expect to see the dollar bid. So at the moment, seeing that dollar weakness story is what we'd expect with a Biden presidency. So the other factor we have to factor in with the dollar is that the dollar tends to strengthen when markets are risk off and weaken when markets are risk on. So just take a look now with me at the S&P 500. You can see here S&P 500, if we overlay the dollar index on top of this chart, we can see that as the equity markets, let's put it onto the daily chart, so it's a bit clearer there. So what we can see, the dollar index is the orange line, and the S&P 500 future market is the lines here. So you can see that as equity markets fall, that supported the dollar. Okay, so a falling equity market supports the US dollar. Now, a rising equity market, and we see a falling US dollar. So at the moment, equity markets are rising, and those rising equity markets further support a weak dollar. That is the relationship between equity markets and the dollar at the moment. Now, there is an important conversation going on in the US, which is the US stimulus bill. Now, the US stimulus bill is a huge package to support the US economy. And you can see that while this talk about this US stimulus bill has been going on, look how US equity markets have been supported, okay? So markets are very optimistic that this stimulus bill is going to be great news for the US economy. Now, this is the important bit. Whether Joe Biden or whether President Trump gets a second term of office, the markets are expecting this US stimulus support to come. So that's why we've been seeing a lot of optimism recently, and particularly over the last few days, we've been seeing strong bids into US equity markets in anticipation of this US stimulus bill that's coming either from Biden or by Trump. So that helps us see some of the big pictures going on, and that is what is moving the dollar. That's what's moving risk markets at the moment, alongside obviously Brexit going on at the moment. But going back to that main chart, you can see the importance of not only the US in terms of FX moves, but also the US and China and their trading partners. Now, obviously, US and Canada have a very close relationship. So this means that US dollar Canadian dollar currency pair is impacted very strongly by trade between the two nations, as well as the US dollar and the Mexican peso. So there is a trade relationship between those countries, and obviously the US dollar Chinese yuan. With all that dollar weakness at the moment, we have, of course, been seeing strength in yuan. So let me just show that to you. I think I've got a, let me just show you. I'm going to go over to another screen for a second. So I just want to show you the US dollar Chinese yuan. I think I've got it here somewhere on an easier way to show it. Let's just see if I've got it here. Just bear with me a second. I did pull this out earlier. No, I haven't got it here. I'll just call it up on the charts. It's going to be easier. Oh, yeah, we'll go to the dollar index and we'll lay it over the top. That's the best way to do it. Okay. And we'll put the so you can see here that as this is the gold line is the US dollar Chinese yuan currency. So you can see that as the US dollar weakens, that's strengthening yuan. So the more we see dollar weakness, the more Chinese yuan strength that we see. See how closely correlated the US dollar and Chinese yuan are, particularly as of late. You can see they're moving virtually in correlation one to another. Okay. Now going back to our presentation, what we can see is whenever we're trading, remind ourselves we want to trade a strong currency against a weak currency. Just like I've shared this analogy before, just like you want to get a strong arm against a weak arm if you're arm wrestling, in exactly the same way, we want to have a strong currency paired up against a weak currency. This is a very, very simple principle, but one that's very, very helpful. And remember, you can share with me during this webinar what trades you're currently in at the moment, and put them in the question box and put them there, and I can give you my comments on your currency choices. Now, that means I'm going to show you a weak and a strong currency pair that we currently have today. And I'm going to make that clear to you. Okay. So at the moment, the weak and the strong currency pair that we have is the euro pound. Now, let me just explain this to you. Now, we can see that the euro is selling off against the pound. Now, the reason for the pound strength is very simple. The UK government had said that on the 15th of October, there would be a withdrawal of the UK from Brexit negotiations if there was no deal still reached. Now, on the news wires this morning, the EU said that they were preparing for a no-deal Brexit, and we saw earlier in the session we saw the pound selling off against the euro. Then all of a sudden, just at 10 o'clock, there was heavy pound buying because the UK, there was a report that the UK was essentially prepared to go past the 15th of October deadline. So that deadline of, you know, if we haven't got a deal by the 15th of October, then there's no deal. That deadline seems to have shifted. So at the moment, we are seeing pound relief, pound buying, on anticipation of either a deal or at least a delay. So there's more time for the UK to strike a deal. So that's pound positive. The euro is weak because the ECB are concerned about deflation. We have, let me just show you, coming up on Friday, we have some very important inflation data out of the EU. So the inflation data is coming out on the EU, and the anticipations are that the inflation data is weak. It's coming in at a very weak reading, okay? So that inflation data is supporting more euro downside because the ECB is expected to act, it's expected to do something, it's expected to have more quantitative easing. Also, we have the euro selling off because there's rising COVID-19 cases in Europe. We also have the huge stimulus package that the European Union has agreed is getting harder to put into practice than some member states had thought. So that stimulus package is a bit more difficult to implement than originally anticipated. So therefore, we can see the euro is weak, but the pound is strong. Remember that principle? This is a key principle. We want to trade a strong currency against a weak currency. And in this instance, the strong currency is the pound, and the weak currency is euro. Now, all these outlooks has a risk, and there's a big risk with this outlook because you only need another headline, don't you? You only need some extra headline, and all of a sudden, you can find the euro gaining against the pound. If Boris Johnson, says, no, actually, we will have a hard deal, a hard no-deal Brexit, then you expect this pair to rip higher very quickly. Now, here's something to be aware of. At 7:30 tonight UK time, the UK PM Johnson is to have a phone call with top EU negotiator von der Leyen. So von der Leyen and PM Johnson are having a telephone call tonight, 7:30 UK time. That's 7:30 British summer time, which is 6:30 Greenwich Mean Time. So 6:30 GMT, 7:30 British summer time. And that will be very key for the pound. So at the moment, the expectations are that the UK is going to keep on and extend negotiations. So as long as that mood remains, we expect euro pound downside. Now, we don't want to buy at the lows. We don't want to sell at the lows here because we see prices quite extended. Now, looking at the daily chart, we can see that price is just rejecting those higher levels, starting to make its way down. But looking at these euro pound, we would potentially favor any retracement back up to this 0.9075 region would be suitable for selling. So if we saw the euro pound move back up to this level, and as long as nothing's changed, as long as the market conditions remain the same, we would anticipate euro pound selling from that level. You see, that is one of the key things, one of the key dynamics that we are anticipating going forward. Now, in terms of other potential trades that we can look at, another potential trade is a trade in gold. Now, I'll just explain what's been moving gold. Now, gold has been moving higher as of late, pushing above this trend line. We are now trying to push above that trend line again, above that 1900 handle. Now, gold has been moving in opposition to the US dollar. So you'll see here, if we overlay the dollar index over the top, you can see, look, that as the dollar falls, gold rises. That as the dollar rises, gold falls. So a rising dollar equals falling gold. A falling dollar equals rising gold. So as long as the dollar keeps falling, we could anticipate this gold trend line staying in place. So a low risk, potentially high reward area to enter this trade would be to enter potentially at market with stops just running below the 100 exponential moving average. So we can see that this 100 exponential moving average is holding and is in place. We see price nudging back above that trend line. So one potential way to play this will be to either enter at market or wait for a bullish close above that trend line on the daily chart. And then some traders will be buying at that position with their stops underneath the 100 exponential moving average, looking for a move back up to 20, 40, 60 and beyond. Now, you know that when you're trading, we don't want to just trade based on the technicals. So the reason that gold upside is still in place is multiple. One, we have low US rates. The Federal Reserve at their last rate meeting said they expect interest rates to remain low right through until 2023. Number two, the Federal Reserve has said that they've got a new targeted inflation system. So now, instead of inflation rising and the Fed raising interest rates, the Fed have said, we're prepared to allow inflation to run higher before increasing interest rates. So the market has an insurance policy, if you like, that the US rates are going to remain low for an extended period of time, even if inflation runs higher. That's very positive for gold. We also have huge quantitative easing taking place in the US, which weakens the US dollar. We've seen, haven't we, the relationship between the US dollar, and we can see, look, with a Biden presidency looking likely, that's further weakness for the dollar. So all of that is a tailwind fundamentally potentially for gold. We also have gold ETFs making record highs recently as investors around the world continue to buy into the gold market. So all of those reasons means that there are some positive upside in gold. Now, just because someone enters here doesn't mean price, you can't get stuffed out, doesn't mean price won't go back down here. The risks to this trade are that the US election spooks investors, that Trump starts gaining in the polls, that the US dollar gains value, and that would invalidate this outlook. But for me personally, I am in this gold trade, and I do have my stops running behind that 100 exponential moving average. And if price move back down, then fine, I'll take my loss and then we look at re-entering down at lower levels and just keeping this trend line as a good opportunity for where to enter. So you can see here, this positive break of the trend line was good. If we get that positive break again, that is more good news potentially for gold bulls. So that's one market that's particularly in play. That potentially could be a good trade to run. Potentially gold has the potential to break out of recent highs and carry on higher. The fundamentals are strong for the solid metal. So that's one swing trade swing trade that I'm in, want to share with you. And again, another interesting trade that I'm in, I'll just share with you again, is in Bitcoin. Now, Bitcoin is an unusual product. The tailwind for Bitcoin is growing. Digital currencies are gaining in value. You may have seen the ECB this week. We're talking about a digital currency. We have digital central banks around the world embracing the idea of a digital currency. And Bitcoin itself has a limited number of coins, and 21 million can be mined, and there's a limited supply. But this weak dollar also supports Bitcoin higher, and this trend line break here is showing some good upside potential for Bitcoin going forward. And if we see a weekly trend line break here, that would really open the upside for Bitcoin going higher. So one simple area would be a 12,193 nth buy on stop. And then as long as price closes above this weekly trend line, staying in the trade. If the trade on the weekly chart goes back into the trend line, some investors will pull. The investors are looking for a short, sharp, hard breakout of this weekly trend line. That's something that I'm looking for. This is a trade that I did again enter, but I entered with this trend line break on the daily chart down here around that 1080. I entered at the 1096 level, just at that, taking out those highs or the 1080 level, one of the two, I can't remember which. Now I'd have to go and open my terminal. It's one that I'm just leaving for a while, and I'm looking for these fresh highs to be taken out on the weekly chart as well. So some traders might enter. I may even add to my position, breaking through there. What would make this turn is obviously if we had dollar strength, that would invalidate this outlook, and any close below this trend line would invalidate the outlook and would be an exit for myself. Okay, that's a few sort of swing trades, a few different things. Yeah, okay, Schwa, Euro Pound, falling wedge, daily time frame. Yeah, Schwa, always think with trading, always think what is the fundamental reason? Okay, what is going on here fundamentally? So daily chart, here we have, okay, Euro Pound. Yes, it formed, it's got that wedge. Now this wedge is typically a continuation pattern. It would normally result in more upside in this kind of symmetrical triangle. But this wedge, we've got a break to the downside, we've got a rejection of that break, and we would expect that to carry on as long as it looks like a Brexit deal is being passed. So the risk for here, Schwa, it's all about Brexit. This is not going to be a technical story. This is going to be a fundamental story first and foremost. If the UK get a Brexit deal done, they'd expect the Euro Pound to fall back down to that 0.8900 at the first instance. So always get into the habit of looking at that fundamentals. Yes, the technicals are great, but look at the fundamentals and combine them with the technicals, because that's when you get the best trades, when you combine the two together. Pound US dollar short. Now the pound US dollar short, I was short the pound US dollar this morning, and I'll explain what changed my bias. So my bias first thing this morning was shorting the pound US dollar chart. I'll show you the technicals, how I traded that. We had a very, very simple trend line break on the daily. You see this trend line break on the 4-hour chart. I just entered short around this area first thing this morning, and then price moved down to that support zone. I moved my stop to break even. Then at 10 o'clock, we had that headline that changed the bias, and the headline was that the UK was prepared to walk past the deal. I'll show you the headline on my squawk. You can see it came in at 10 o'clock, just after 10, and it changed my bias. You can see here, just after 10, the UK has signalled that it would not walk away from discussions with the EU immediately, according to reports. So in other words, the UK said at that point, we're not going to walk away from the talks. Now, if they say they're not going to walk away from the talks, that's pound positive. So immediately, my bias to short the pound has changed, and then I have a bias to go long the pound. I was knocked out at break even because price moved up before I could close the trade out, and I was just taken out at break even. So pound US dollar short at the moment is not the right trade, because expectations are that the deal's going to be done. You see, Schwa. So if expectations the deal can be done, that's going to push the pound higher and drag the US dollar lower. This is what's also dragging the US dollar lower today. Okay, so if a deal is done, expect that to further drag the US dollar down and be positive for risk. Now, what would change the outlook, Schwa? Well, it would be later. PM Johnson is due to meet with von der Leyen on a phone call, 7:30 UK time, 6:30 GMT time tonight. Want to come back to, because if PM Johnson says no, I can't get a deal done, then the pound will tank. It will fall very, very hard, very quickly. So that's one to be looking at. 7:30, 8 o'clock UK time this evening. So I hope that's made sense to you, Schwa. I hope you can see that what's driving the pound, it's not the technicals, it's the fundamentals, and then we're just using the fundamentals to guide ourselves about where to be going. For gold will be up either Trump or Biden wins. Now with gold, what's driving the gold at the moment? It's the US dollar. So remember, if you can see, look, dollar down, gold up. Dollar up, gold down. Gold's being pushed around by the dollar. If Trump wins, that will be dollar positive, so gold negative. If Biden wins, that's dollar negative, gold positive. So as long as Biden is remaining ahead in the polls, that should be dollar negative. But you know, the polls are difficult. They don't always reflect what's going on. And remember, if investors get spooked, and the thing that can spook investors at the moment is the US election risk. And there is a risk. You may have heard President Trump talking about you know, postal ballots, you can't trust them, yada, yada, yada. Well, there's a phenomenon called the blue shift. And there was an academic who wrote a paper on the fact that in all elections since the year 2000, when postal ballots are finally counted, it benefits the blue party in the US, which is the Democrats. So in other words, if the election is a very close call thing, you could see there being a situation where President Trump thinks he's the winner, but then when the postal ballots are counted, he isn't the winner. And you can imagine President Trump, how he would respond to that. There would be chaos. So the closer this Biden-Trump gap is, the more likely there is to be confusion at the elections. If there's confusion at the elections, that's dollar positive, which is gold negative. So that's the expectations at the moment. Broadly speaking, I think the market is still gold positive on a medium term. Just got that US election coming up, which could result in some short-term volatility, and that could result in being stopped out. So that's a risk with that trade. Yeah, Warren, that's right. A new score is a good advantage. It does help you to know, what's going on, and a good Squawk service and a good access to good analysts just helps you find your way to the market. Warren, purely political now, driving FX market, presidential election, stimulus package, Brexit, so hard to predict politicians. That's right, Warren, you've got it. It's a very fundamentally driven market. And if you just take a look at the economic calendar, you can see, look, there's, okay, Friday, we've got some things coming on. Very little going on this afternoon on the 14th of October. Got some crude numbers out. But apart from that, we got a speech tonight from our Governor Lowe. That is something to be looking out for. So markets are pricing in now a interest rate cut from the RBA in November. Okay, so the RBA will be speaking early. Let's just find out where he is. So it's early tomorrow morning. Let's see where we've got him. Yeah, here we go. So yeah, okay, so it's late tonight, 11 o'clock UK time. RBA's Governor Philip Lowe speaking. Now, what the pair to this is to look at the Aussie New Zealand dollar. If Governor Lowe says, Australia's doing pretty well, we don't think we will be cutting interest rates. If he keeps a more on hold position, that would be very positive for the Australian dollar, because the Australian dollar has been selling off recently as the market has been starting to price in an RBA rate cut. So if you just look at the Australian New Zealand dollar, we'll just call it up here. All right, just here's the Aussie New Zealand dollar. We'll just look at that on the daily chart. We'll now look at the bond yields. So we compare the Australian 10-year bond yield, and we'll take away the New Zealand bond yield, and this gives us a risk profile of the pair. And you can see, look, the bond yield spread has fallen between Australia and New Zealand as bond traders are starting to price in an RBA rate cut, and that pressures the Aussie New Zealand dollar. But if RBA Governor Lowe tonight, if when he's speaking says, Australia's doing better than we thought, I don't think we'll need to have a rate cut. If he starts saying anything like that, he won't say anything won't be as obvious as that. It will be coined in financial language, but that's the bottom line, is if we see RBA walking back from rate cuts, that will be strong Aussie New Zealand dollar upside, because in New Zealand, government are talking about potential negative interest rates. So then we'd see sharp upside in the Aussie New Zealand dollar, looking at a test of 1.1. So that is one to look at as well. Yeah, Warren, you're spot on. Schwa. Yeah, fundamental and technical analysis sometimes are different. What should we do that time? That's a great question. Basically, the trades you want to be taking, Schwa, is when the fundamentals and the technicals agree. So you want to find trades that have fundamentally strong reasons, and you want to find trades that have good technical setups that make sense. When you find those two together, Schwa, that, in my opinion, is when you're trading correctly. You're trading the fundamentals and the technicals, and you're managing your risk. You're then trading like a professional. So that is what we're trying to do here, Schwa. That's what I'm trying to show in this workshop, how to combine the fundamentals and the technicals. And I'm giving you some examples of trades I'm taking and the rationale for it. Yeah, no, Warren asked a very good question here, and he asked the question, what's the, I'm just going to send this out to everyone, your question, Warren, so everyone can see it. Warren asked, what's the impact to the Australian dollar that the coal import ban by Beijing? It seems not seen at the moment. Please correct me if I'm wrong. Thanks. Right. If you just go over to the OECD, right. Right. Take a look at this, Warren. Now, this is the export data for Australia. Okay. Now, Australia exports a huge amount of coal. You can see that 23% of Australia's exports are coal related. And the destination of a lot of that coal goes to China. So 18.6% of Australia's coal goes direct to China. So as you can imagine, Warren, if the rumor is true, and remember this is still not confirmed, but if China has banned or heavily restricted the import of Australian coal, that will badly impact the Australia's economy. Look how much, yeah. So, you know, that's 20% of its largest export suddenly knocked away. So that would have a big impact on Australia's economy. Now I'll show you one more thing. Let me just find it. Just bear with me a second. I'm going to show you. I'm just going to get another trade flow diagram out. And this will be worth seeing. So just going back here, my friends, let's have a look. Yeah, so you can see Australia, their largest trade partner is China. So around 30% of all Australia's GDP comes from its trade with China. Okay, so now you can see we're on the importance of this. Now, the reason why, you know, hasn't necessarily seen a lot of impact on the Australian dollar at the moment. Just go over to the Australian dollar, we can see that there's not a whole deal of reaction in it. In fact, you know, the Australian dollar is being a little bit supported at the moment due to dollar weakness, right? But if that is confirmed, you'd expect some heavy Australian dollar selling. So it's a risk factor to look at for the Australian dollar. And Warren, again, it's a potential trade. So if you had a news squawk and you got that news out, you'd know there'd be some heavy Australian dollar selling, a quick trade in the Australian dollar. So that's the sort of situation that you can be looking for, and definitely a potential risk impact. Now, on the wider picture, Warren, you know, think about it. If a Biden presidency comes into play, then we're going to see some of these tensions that have developed between the US and China fade into the background, and also some of the tensions most likely between China, UK, Australia, maybe Germany, they're going to fade into the background as well. Because what started as a US versus China problem risks now becoming a China versus the West problem. A Biden presidency will dial all that back and allow relationships to be a lot more cooperative between global nations, and you know, that's one of the kind of impacts we might see. I hope that's helpful, Warren. The main issue with that is it's not confirmed yet. It's kind of a little bit of a rumor, a little bit of hearsay. Different officials are talking about it, but there hasn't been an official statement to Australia yet on that coal import ban. That's the thing. Yes, Warren, thank you. You put it into a nutshell, a potential theme. That's it. An emerging issue could be a big one, worth keeping your eye on. Excellent. Okay, folks, I think that's got to the end of the questions. It's been a pleasure, as always. Thank you all very much for your questions. Warren, some great observations and questions there. Shua, thank you for your questions as well. I hope that's been helpful for you. Yeah, thank you very much. And don't forget, Monday, we'll be looking at the week ahead. And don't forget to come back here, same time next week, and we'll run through different currency pairs. And why don't you, you know, try and put into practice what I'm just saying. Try and do this in the week. Try and show some of the things that I've been sharing with you of this strong currency versus the weak currency. Have your reasons for it. Maybe have a look at some swing trades, and then we can talk them through. And I can help you learn by showing, you know, think about this. Have you considered that? And it's how everyone learns, just taking our time. Okay. Thanks, everybody. Take care now. Goodbye.